This video is going to look at the basics of balance sheets. So it's going to consider what a balance sheet actually is, how it's constructed, and what does it actually tell us, what does it measure. So first of all, it's simply a statement, and a statement which I suppose helps investors or helps different types of stakeholders recognise how liquid the firm is. And what I mean by liquidity is how easy is it for the firm to meet their financial obligations. So have they got enough cash, or have they got enough within the company that they can convert into cash to be able to pay off what is due. And there's key elements that are involved within a balance sheet, and they are assets, liabilities, and equity. And within this video we're going to break down assets, break down liabilities, and explain why equity is also essential. So to start off with, we're going to look at non-current assets. The fact that they're non-current might give you a bit of an idea of what that relates to. The fact that it's non-current suggests that it could be needed for the long term. And what I mean by an asset is that, again, it can be converted into cash, or it quite possibly is cash. But when we're looking at a non-current asset, the likely examples that you may see in a question is the following. So you could think about property. If the business owns the property, then that is a non-current asset that belongs to the firm. So if the firm wanted to, for whatever reason, they could convert that into cash. The likelihood is they wouldn't, especially in the short term, because they will need it for the operation of the company. Again, machinery or equipment, vehicles, all of that is being used by the business in the short term to be able to produce goods. But in the long term, if they wanted to, they could convert it into cash. Trying to find the buyer might be a little bit more difficult as well, and that's perhaps why it would be considered to be a longer term option. Current assets, again, look at the name, current. It's more to do with the day-to-day. Okay, it's more to do what they can convert into cash as quickly as possible. It might even be cash. But again, some of the other examples you've got is stock or inventory. So if you think about businesses that sell many goods, all the stock that they possess, they're expected to be sold, and the reason why they're expected to be sold is so it can be converted into cash for the business. If there's a company who sells mostly services, then yeah, maybe they would have less current assets in comparison when it relates to stock and inventory. Another really key example that you should know is a trade receivable, or it's sometimes known as a debtor as well. And what that relates to is the trade credits that the firm has given out. So if the firm has given out a trade credit to maybe a customer, maybe it's to try and attract a sale, and maybe they had to offer better credit terms to attract that customer to their business. And let's say, for example, it's 28 days. They will be expected to convert that sale into cash within those 28 days. So they are waiting to receive the money, but they should receive it very soon. So again, just a reminder, non-current assets are much more longer term assets. They wouldn't expect to convert them to cash instantly or in the current situation. Current assets, they would be expected to convert them into cash, and it might even be cash already. So the next crucial element is liabilities, and liabilities are related to those financial obligations. What does the business owe? Now, the business might owe money in the current situation, so in the short term, or they may owe it in a much more longer term time period. So to start off with, when we're looking at current liabilities, the examples might be, for example, an overdraft. We know that overdraft is a short-term source of finance. And if they've had to dip into their overdraft, and again, what I mean by that is maybe they haven't had enough money in their accounts, they've had to maybe use excess, maybe they've had to use their overdraft facilities, which the bank allows, they will have to pay that off in the short term, or they're expected to pay it off in the short term. Another one is tax. So again, if it's, for example, VAT, all the time they're selling goods, they might have to pay the VAT to the government, so that would be money owed out. If again, shareholders would expect regular dividend payments. And another really key one, and it relates to trade receivables, but it's the other way around, and that is trade payables. sometimes known as creditors. And what that means is that this time the business has received the trade credit. So they may have requested one from their supplier. And again, let's use the example of 28 days. That means that this business will have 28 days to make that payment. And that is why it's a current liability, because it is due in the current terms and the current situation. Non-current liabilities has a much longer time period to make that payment, and it'll have been agreed by, for example, contracts and so on. So good examples might be a longer term loan. You've agreed the contract with the bank, you recognise when this should be paid off in full. Or the mortgage, which obviously a much greater loan based on property. Again, there'll be an end period date when the bank expects this to be fully paid off. And because it's ongoing and it's not going to be paid off for a very long time, perhaps, that is why it's a non-current liability. Once the business knows what their current assets, their non-current assets, their current liabilities and their non-current liabilities, they can start to get an overview of again of their business and their finances. So for example, if they wanted to know what their current situation is and how their current assets compare to their current liabilities, they can then calculate their net current. Now the net current is really simple. It's simply the current assets minus their current liabilities, and that's all it is. Or they could go one step further and just simply work out their net total. Now their net total is important, and it's a difference really between your all your assets, so you obviously your current and your non-current, minus your non-current and your current liabilities. So the final part of the balance sheet and the elements of the balance sheet is equity, and equity is the reason why this is called a balance sheet. And the reason for that is because if you add your equity to your total liabilities, then it should result in the same amount of your total assets. So your total assets should balance out to equity plus total liabilities. And if it doesn't, then you've made a mistake constructing your balance sheet. So it's simply the value of assets less the amount of all liabilities. But what equity is pretty much what sources your assets. Where's the finance coming from to actually purchase some of your assets? And the two most common examples which you'll most likely see in your exams is share capital, or obviously it can be known as share equity, or retained profit. So retained profit might help fund some of your assets, and share capital, the investment from investors or from your shareholders, will also help to fund it. And just remember, your total liabilities plus your total equity should result in the same amount of your total assets, and that should give you the idea of again how liquid this company is. And this is just a quick example, just a quick snapshot of what a balance sheet would look like. You would have different compartments of your balance sheet, such as your assets, your liabilities, your owner's equity, and in your exams, IB A level, you'd see something quite similar to this. GCSE, it'd be much more straightforward. But as long as you can see and you can determine what are your current assets, what are your non-current assets, what are your current liabilities and your non-current liabilities, and finally your owner's equity, you'll be absolutely fine. And just a reminder, your total assets should balance out with your equity plus your liabilities.